108,000 layoffs. That's how many jobs American companies announced they were cutting in January 2025 alone. This number is up 118% from last year and up 200% from December. We haven't seen numbers like this since 2009, right after the housing market collapsed and the financial system nearly imploded. But here's what they're not telling you. The layoffs are just a symptom. The real disease is spreading through the US Treasury market, and China just made a move that could bring the entire system crashing down. Companies are shedding employees at record pace because they can't expand. Revenue is drying up as people stop spending in the broader economy. Normally, when businesses hit a rough patch, they borrow money to ride out the storm. They take on debt, keep their workforce intact, and wait for conditions to improve. But that playbook isn't working anymore. Credit has become extremely expensive. Top-tier companies in the United States, the bluest of blue-chip corporations, are now borrowing at nearly 5% interest rates for short-term debt. If you need long-term financing, you're looking at nearly 6%. And remember, these are the numbers for the biggest corporations in the United States. Smaller companies are paying much higher rates. When you're facing that kind of burden and you have no clarity about your business plans for the next year, there's only one option left. Cut expenses. And cutting expenses means cutting people. So rates need to come down, right? The Federal Reserve should just lower interest rates and solve the problem. Except there's a fatal flaw in that assumption. The Fed can control short-term rates. They can slash them down to zero or even negative if they wanted to, but they cannot control the 10-year Treasury yield. The 10-year moves according to supply and demand. Do global investors desire U.S. debt? If demand for U.S. bonds falls, rates will have to adjust upward to attract more buyers. And right now, the biggest buyer in the market is walking away. China is ordering their banks to limit bond holdings. This isn't a suggestion or a gentle recommendation. These are direct marching orders from Beijing. Stop buying treasuries, and if you already hold a significant position, it's time to start cutting it down. The U.S. bond market is dependent on foreign buyers. At least 30% of bond demand comes from global investors, including central banks and foreign commercial banks. The biggest Chinese banks are either state-owned or highly controlled by the state. Beijing has enormous influence over these entities, and they're using that influence right now to pull the plug on American debt. Let's put this in perspective. China once held over $1.3 trillion worth of U.S. bonds in their reserves. That was back in 2013, and a huge amount was purchased in the wake of the housing collapse. Beijing went in to buy U.S. bonds even as the Federal Reserve was dropping helicopter money and bailing out the banks, even as the dollar was being debased. China was doing Washington a solid. But those days are over. China's holdings have dropped well below $700 billion, and by the end of this year, it will probably touch $600 billion or below. Beijing telling their commercial banks to limit bond holdings is a sign that the game is over for Washington, and de-dollarization is hitting the commercial sector. Chinese banks today hold nearly $300 billion in dollar-denominated debt. A big portion of this is held in treasury bonds. Beijing eventually wants this amount to collapse. The stars are lining up toward a full de-dollarization of the Chinese economy. It started with government reserves. Then it spread to global trade. Now it's hitting the financial sector. When Trump imposed tariffs on China, he accelerated the plan for non-dollar trade. The Chinese were going to do it regardless. Bilateral trade with partners was already increasing. But now they have the ultimate excuse to nudge their financial sector to dump dollar holdings. Why would you hold dollar assets when trade with the U.S. is dropping? Here's the data that should terrify Washington. At its peak, China's share of U.S. imports was 22% of the total. That number has fallen below the 2000 levels of just 7.5%. When Chinese importers buy less from the U.S., the need to settle trade in dollars collapses. They need to borrow less from Chinese banks to fund that trade. China is nudging their banks to face reality. The need to hold huge dollar reserves doesn't make sense anymore. The official excuse Beijing is using is market volatility. The real reason is simple: to de-dollarize and sanction-proof the Chinese financial system. When Americans think of global banks, we recognize the big U.S. names: J.P. Morgan, Bank of America, Citigroup. But those rankings are based on market capitalization, which reflects how much value the market assigns them. In terms of actual assets under management, Chinese banks are the biggest in the world. The 4 largest banks globally are all Chinese, from ICBC to Bank of China. They manage far more money compared to other global banks. And because the Chinese economy is still growing fast, their assets under management will continue to balloon. Beijing telling them to stop buying treasuries means future demand for U.S. government debt will dry up. The whales are leaving the market. But there's another dimension to this that goes beyond simple economics. China has watched what happened to Russia. When you buy or hold treasury bonds, the assets are not physically in your possession. They're either held by a custodian bank within the United States or with the Federal Reserve. Either option means your holdings can be frozen or confiscated. At Davos, Trump was asked about European pension funds planning to exit $100 million in treasuries at the end of December. He was asked if European countries holding trillions in U.S. stocks and bonds might sell in retaliation. Trump's response? If they do, they do. But if that would happen, there would be a big retaliation on our part, and we have all the cards. Think about what that means. China is sanction-proofing itself. Why would you hold an asset that can be weaponized against you? If China doesn't hold treasury bonds, there's no risk of confiscation. The U.S. just handicapped itself with that statement. If you want the world to even consider buying your debt, the very least you could do is not threaten them. But China not buying is just an external threat. The biggest threat to the U.S. isn't Beijing, it isn't Russia, it isn't BRICS. It's actually the U.S. itself, treating its own currency and bond market horribly. The incoming Fed Chair Kevin Walsh has a new radical idea that might just destroy the value of U.S. bonds. He's calling for a new Fed Treasury Accord that could literally blow up the 30 trillion. The 1951 Treasury Accord was created immediately after World War II to prevent an inflation crisis. Before the Accord, the Fed was forced to buy government debt to prevent yields from exploding. They basically printed money for the president to spend. The Accord was implemented to separate monetary policy and government debt management, to prevent endless money printing. Walsh is thinking of drawing up a new accord, and this could be disastrous for the US dollar and bonds. Trump would be overjoyed because finally the Fed would help him as Scott Bessent runs up the numbers. This plan copies Japan's yield curve control, where the central bank buys up massive amounts of government bonds to forever suppress yields and artificially lower borrowing costs. If this happens, we could enter an era of eternal money printing where the dollars in your pocket lose meaning and value. The Fed today holds $4.2 trillion of U.S. treasuries, most of it over 8 years in tenure. They've been buying long-term bonds. But the ideal scenario Trump wants is for the Fed to not just lower rates, but to buy short-term bonds as well, to shift all the buying toward T-bills and finance the Treasury directly without hesitation. You would have the Fed setting dirt-cheap rates and also buying up what Bessent issues, a living, breathing money-printing machine. When you shift buying to T-bills, you are directly injecting money into the economy. You increase the money supply directly, and inflation will rise faster than ever before. It gets worse because the Treasury will have to rely on the Fed to forever buy bonds. It will be a forever stealth quantitative easing where any shortfall will be fueled by the Federal Reserve printing money. But this won't give Trump what he thinks he'll get. Despite the Fed cutting rates in 2024, bond yields on the 10-year have not moved. They remain elevated, which tells us the real economy is shunning U.S. bonds. Why? Because the value of the underlying asset, the dollar, is collapsing. Even if the Fed cuts rates to zero and buys only T-bills, long-term rates could stay at 4.5% or even rise much higher. What will change is the value of the dollar. It will crash even faster against other currencies. China ordering a sell-off is only a symptom of the bigger problem. The origin of the crisis lies in Washington itself. Besant can't stop borrowing, and Trump can't stop spending. Roping in the Fed to buy T-bills might save the federal budget, but it would collapse the entire debt market structure. The value of the dollar would plunge, and more countries would want to dump bonds even further. Look at the biggest buyers and sellers of U.S. bonds. The top 3 dumpers are countries in the BRICS: China, Brazil, and India. They dumped almost $200 billion worth. But the top 5 buyers, their purchasing is not guaranteed going forward. Europe is being threatened if they dump existing bonds. Japan is facing a currency crisis and could turn into net sellers if things get nasty. Canada is moving away from the US, selling more oil, gas, and commodities to Asia and China. They would also likely reduce their Treasury buying. Trying to destroy the 1951 Accord will be the last straw. If the Fed backstops the Treasury, if they are connected once again, currency debasement will accelerate. And if you think gold at $5,000 was bad, if you think inflation was bad, it would reach epic new levels. Which country do you think will be next to dump even more treasuries? And will they really tear apart the 1951 Accord just to print money? Drop your thoughts in the comments below, and don't forget to subscribe as we navigate through these crazy times.